Welcome back, everyone. We're about to jump into part 2 of Blu Sky's Investment Readiness webinar. So when we left off in part 1, we were talking about the importance of not failing to monitor your cash runway. So let's just now have a little bit more of an extended look at what we mean by cash runway and what we can do to help extend that period. So runway is the time, usually expressed in months, until the startup runs out of cash. And understanding runway helps business planning and drives decisions around when to raise. If the runway is 9 months and the next round will take 6 months to raise, then the startup better get raising pretty fast. So do ensure that you report on runway at least every month. And do find every way possible to extend your runway. A longer runway means more time to gain traction and build a product or service. And greater traction means a higher valuation and therefore a bigger raise when the time does come. More than that, a short runway results in key people spending time away from the growing business, as more and more time is taken up by sourcing finance and worrying about survival. Short runways are bad for everybody involved. So what can startups do to extend their runway? Well, one of the very best runway extenders are R&D tax credits. R&D tax credits are another government-backed scheme which results in significant cash paid back to companies involved in developing new and innovative products and solutions. There are two schemes, of which both pay cash into the pockets of companies, but the SME scheme for small companies is by far the most advantageous. So you should expect to get about 33 pence in every pound spent on an R&D activity back in tax credits under the SME scheme, and about 9 pence in every pound under the large scheme. However, please don't solely rely on R&D tax credits to fill a hole in your runway. Please treat R&D as a bonus, and don't plan your financial model on R&D being a life or death cash receipt. Nothing with HMRC is certain, and planning for a tax credit being the only option to fill a cash gap may very well end in tears. So like most things, ask your accountant well in advance if it's looking like R&D is going to be a deal breaker, and they should be able to help you plan either way. So let's just move on from R&D and have a quick look at some of the other runway extenders. Debt finance or borrowings in the business. There's a whole world of borrowing solutions available, and fintech products are causing an explosion of online borrowing options. And although it's true that securing debt finance can be difficult for a startup with a small balance sheet, the new options to the market are making it more likely than ever that a startup can access at least some form of debt finance. One such source of debt finance are startup loans. Startup loans are government-backed and are available up to £25,000 per applicant for new startups and are repayable over 5 years. However, please don't forget that startup loans are personal loans. Yes, they are meant for business, but they're secured against the applicant personally, and regardless of whether the business succeeds or fails, the loans need to be repaid. And the final runway extender, grants. So depending on your geographical area, there's usually some form of government-backed grant available to help you either start a business or for R&D purposes. And while often great, please remember to take a second to check the conditions of the grant, and here's why. Where grants are classified as state aid, EU rulings mean that in some circumstances, taking a small grant on a project can exclude that project from further state aid. Unfortunately, small scheme R&D tax credits are also classified as state aid, and therefore it's entirely possible that taking a small grant can sometimes exclude a full project from claiming R&D in the small scheme at 33 pence in the pound, and therefore potentially result in the loss of tens of thousands over the lifetime of the project. So please, just remember to ask about the state aid implications of any grant before taking it. Okay. So finally, I just want to touch on the benefits of surrounding yourself with the right advisors and mentors. For those that do it, Starting and growing a business will likely be one of the hardest things most people do in their lives, so having the right team is crucial. But team extends beyond the people on payroll. Startup teams should include mentors, investors, and professional advisors to help guide the startup from as early as possible. But to derive value from this extended team, it's critical that the startup surrounds itself with people that it can both trust implicitly and communicate with effectively. A solid set of advisors should be a huge part of every startup team. So what does that mean to me and to Blu Sky as startup accountants? What do startup accountants need to do differently that maybe other accountants don't need to do? Well, through working at Blu Sky with early stage companies, through talking to founders and listening to our own mentors, it's clear to me that what we need to do above and beyond just being numbers crunchers boils down to just 3 things. To be an effective member of any startup's team, a startup accountant should always listen. To be an effective member of any startup's team, a startup accountant should always educate. And to be an effective member of any startup's team, a startup accountant should be focused and should do everything possible to extend the startup's runway. And if we do that, and if we work together as a team, then hopefully we can help you to take off. That's it. Hopefully you've enjoyed this video. If there's anything else we can help you with, please get in touch. The website's www.blusky.co.uk. Thank you very much.